What if everything you owned, every dollar you saved, every investment you made suddenly became worthless? It's not a pleasant thought, is it? I'm not going to let that happen, and you are neither. We trust in the systems, in the banks, in the very concept of money. But history has a way of shaking us awake, of reminding us that even the seemingly impossible can happen. Imagine a world where currencies crumble, where markets collapse, where the global economy shudders to a halt. This isn't just the stuff of dystopian fiction, it's the potential fallout of a very real threat, World War III. Tensions are simmering between superpowers, old rivalries are reignited, and the specter of conflict looms larger than it has in decades. Consider the world we live in. From the ashes of a shattered world, a new order emerges. This isn't just a history lesson, it's a recurring pattern. World War I reshaped the geopolitical landscape and triggered economic chaos. Empires crumbled, currencies faltered, and the world grappled with the devastating costs of war. The Second World War further cemented the relationship between conflict and financial upheaval. Today, the possibility of another world war is being whispered in hushed tones in corridors of power and debated on news channels. The conflict in Ukraine has sent shockwaves through the global economy. Energy prices have skyrocketed, supply chains disrupted, and the threat of a wider conflict hangs heavy in the air. This isn't just about distant battlefields and geopolitical maneuvering. This is about your life, your savings, your future. The financial fallout of a global conflict, especially one fought with the terrifying technology of the 21st century, is almost unimaginable. We need to understand the risks, the potential consequences, and how to prepare for a future where the very nature of money may be forever changed. Over the next few minutes, we'll delve into the potential financial fallout of World War III. We'll examine historical patterns, analyze expert predictions, and explore steps to safeguard your financial well-being. Let's begin. History doesn't repeat, but it often rhymes. To understand the potential financial fallout of World War III, we need to look back at the echoes of the past. World War I shattered the existing economic order. Great empires crumbled under the weight of war debts, their currencies collapsing like houses of cards. Germany, once an economic powerhouse, found itself crippled by hyperinflation. The cost of everyday goods soared astronomically, wiping out the savings of millions. People were forced to carry wheelbarrows full of cash just to buy a loaf of bread. The social and political consequences were devastating, paving the way for extremism and further instability. World War II further reshaped the global financial landscape. The conflict left Europe in ruins, its economies shattered. The United States emerged as a global superpower, its currency, the US dollar, taking center stage. The Bretton Woods Agreement of 1944 established a new global financial order, with the US dollar as the world's reserve currency. This system brought a period of relative stability, but also sowed the seeds of future economic vulnerabilities. The world became increasingly reliant on the US dollar, making it susceptible to fluctuations in US economic policy. The petrodollar system, which emerged in the 1970s, further cemented this dependence. But the sands of power are always shifting. The rise of new economic giants like China has challenged the dominance of the US dollar. The euro, the currency of the European Union, has also emerged as a potential rival. The conflict in Ukraine has further exposed the cracks in the existing global financial order. Sanctions against Russia have sent shockwaves through global markets, highlighting the interconnectedness and vulnerability of the global economy. The potential for a wider conflict raises the stakes exponentially. It's about a fundamental reshaping of the global financial system, with potentially catastrophic consequences for billions of people. In our interconnected world, goods flow across borders seamlessly. But this intricate web, the global supply chain, is fragile. It relies on peace and stability, which can be disrupted in an instant. Imagine a world where the seas become battlegrounds, and the skies are patrolled by fighter jets. Supply chains would snap, leading to scarcity and skyrocketing prices. The conflict in Ukraine offers a glimpse into this dystopian future. Hyperinflation, a word that sends chills down the spines of economists and everyday citizens alike, is not merely a theoretical concept confined to dusty history books. It is a terrifying reality that has reared its ugly head time and again throughout history, often in the aftermath of devastating wars. Germany, in the wake of World War I, offers a chilling example of how quickly a nation's economic foundations can crumble under the weight of hyperinflation. Imagine a world where you need a wheelbarrow full of cash just to buy a loaf of bread, where your life savings are wiped out overnight, where the very concept of money loses all meaning. This was the grim reality for millions of Germans in the early 1920s. The German mark, once a symbol of stability and prosperity, became virtually worthless, its value plummeting at an astronomical rate. People were paid their wages in suitcases full of cash, only to see its purchasing power evaporate by the time they reached the shops. The social and political consequences were catastrophic. The middle class, the backbone of German society, was decimated, their savings wiped out. Extremist movements, capitalizing on the widespread despair and resentment, found fertile ground to sow their seeds of hate and division. The Weimar Republic, already weakened by war and political instability, collapsed under the weight of hyperinflation, paving the way for the rise of Nazi Germany. The stock market can turn from a bull to a bear in the blink of an eye, especially in times of global uncertainty and conflict. The mere hint of war can send shockwaves through global markets, triggering panic selling and wiping out trillions of dollars in wealth. Investors rush for the exits, seeking refuge in safe haven assets like gold, silver, and real estate. Imagine the Dow Jones plunging thousands of points in a single day, where trading is halted and retirement accounts are decimated. This is not a scene from a Hollywood disaster movie. It is a very real possibility in the event of a global conflict. Governments, faced with the immense costs of waging war, often resort to a dangerous game of financial alchemy, printing more money. This seemingly easy solution, however, comes with a hefty price tag: inflation. As more money floods the system, the value of each individual unit of currency declines, leading to a rise in prices. In extreme cases, this can spiral out of control, leading to hyperinflation, as seen in Weimar Germany after World War I. The world is already grappling with a mountain of debt, accumulated over decades of reckless spending and loose monetary policy. The COVID-19 pandemic, with its lockdowns and economic disruptions, only exacerbated the problem, forcing governments to borrow trillions to keep their economies afloat. A global conflict, with its astronomical costs, would push this debt burden to breaking point. Governments, desperate to finance their war efforts, would be tempted to print even more money, further fueling inflation and potentially triggering a sovereign debt crisis. Imagine a world where interest rates skyrocket as investors demand higher returns to compensate for soaring inflation, where governments are forced to impose harsh austerity measures to rein in spending, where social unrest explodes as people struggle to make ends meet. This is the potential fallout of a debt bomb detonation, a reckoning deferred for too long. The economic consequences of a global conflict would be felt for generations, leaving a legacy of poverty, instability, and social unrest. In this maelstrom of economic uncertainty, a new player has emerged on the global financial stage: cryptocurrency. Bitcoin, the enigmatic digital currency that has captivated investors and confounded regulators, is often touted as a safe haven asset, a digital gold that can weather the storms of traditional financial markets. Its decentralized nature, operating outside the control of governments and central banks, is seen as both its greatest strength and its biggest weakness. Proponents of Bitcoin argue that its limited supply, capped at 21 million coins, makes it an effective hedge against inflation. Unlike fiat currencies, which can be printed at will by governments, Bitcoin's scarcity is hard-coded into its underlying technology, making it resistant to manipulation. In a world teetering on the brink of economic chaos, Bitcoin's appeal as a decentralized, censorship-resistant store of value could grow exponentially. However, Bitcoin is not without its critics. Its volatility, its susceptibility to market manipulation, and its association with illicit activities have made it a target of regulators worldwide. Governments, wary of losing control over their monetary systems, could crack down on Bitcoin and other cryptocurrencies, restricting their use or even banning them outright. The future of Bitcoin in a world ravaged by war is uncertain, a digital wildcard in an already unpredictable game. For decades, the US dollar has reigned supreme as the world's reserve currency. But even suns eventually dim, their fiery dominance giving way to the encroaching twilight. Could a global conflict hasten the dollar's decline, marking the dawn of a new financial paradigm? The US economy faces growing competition from rising powers like China, and the US military is stretched thin across the globe. As the pillars of American hegemony crumble, so does the dominance of the dollar. The ascent of the East, a new financial axis. As the sun sets on the West, a new dawn is breaking in the East. China, with its burgeoning economy, is positioning itself as a potential challenger to the existing world order. Its currency, the yuan, is already being used in a growing number of international transactions. China has been actively promoting its use as a reserve currency. A global conflict could create an opening for China to accelerate its ambitions. China is not alone in its quest for a new financial order. Russia, too, has been seeking to reduce its reliance on the US dollar. It has been accumulating gold reserves, promoting the use of its own currency, the ruble, in international trade, and forging closer economic ties with countries like China and India. The BRICS nations have also been pushing for a more multipolar world, one where the US dollar is no longer the sole arbiter of global finance. This shift towards a multipolar financial system is not without its challenges. The yuan, while gaining traction, is still not fully convertible on international markets, and China's tightly controlled capital account limits its appeal as a truly global currency. Russia's economy, heavily dependent on energy exports, is vulnerable to fluctuations in global commodity prices, and the BRICS nations often struggle to present a united front on key issues. Despite these hurdles, the momentum towards a new financial order is undeniable. A global conflict could accelerate this process, creating both opportunities and risks for countries seeking to navigate the shifting sands of global finance. War's grim bounty, profiteering in the rubble. War's horrors are a boon for certain industries, lining the pockets of those who peddle in death and destruction. Companies like Lockheed Martin, Raytheon, and Boeing see profits soar as demand for military equipment skyrockets. Beyond defense, sectors like reconstruction, cybersecurity, and private security also benefit from war's chaos. Commodities like oil and gold spike in value, while opportunists exploit shortages for gain. Amidst the suffering, a select few profit handsomely from the carnage, their fortunes rising from the ashes. Digital havens and dystopian dollars crypto in the crosshairs. As the global financial system teeters, many look to cryptocurrencies as an alternative. Once niche, cryptocurrencies are now mainstream, offering decentralized and anonymous transactions. Bitcoin, often called digital gold, is seen as a hedge against inflation. Its limited supply and resistance to censorship attract those seeking financial security. In crises, Bitcoin's appeal grows as faith in fiat currencies wanes. But cryptocurrencies face risks like volatility and regulatory crackdowns. Governments may restrict or ban them to maintain control. The future of money is uncertain, with cryptocurrencies challenging traditional systems. The age-old adage, "Don't put all your eggs in one basket," rings truer than ever in the face of potential global conflict. Diversification is critical when the global economy is at risk. Spread your risk across various investments to safeguard your financial well-being. Relying solely on traditional assets could prove disastrous in a volatile market. Diversify to mitigate risks and protect your investments. As the storm clouds of conflict gather on the horizon, the prudent seek shelter in safe havens assets that have historically held their value or even appreciated during times of economic and political turmoil. These aren't get-rich-quick schemes or speculative bets. They are tried-and-true stores of wealth that have provided a measure of security and stability for centuries. Gold, often referred to as the ultimate safe haven, has weathered countless storms throughout history, from wars and revolutions to economic depressions and currency collapses. Its scarcity, intrinsic value, and universal appeal as a store of wealth have made it a go-to asset for those seeking to preserve their capital during times of uncertainty. Silver, often considered gold's less glamorous cousin, shares many of the same characteristics, offering a more affordable entry point for those seeking diversification. Real estate, while not as liquid as precious metals, can provide a tangible hedge against inflation and a sense of security that paper assets often lack. Owning a piece of land, a home, or even rental properties can provide a steady stream of income and a store of value that can withstand economic shocks. Beyond these traditional safe havens, alternative assets like fine art collectibles and even cryptocurrencies have gained traction as potential hedges against inflation and market volatility. However, it's crucial to approach these assets with caution, as their value can fluctuate wildly and their long-term prospects remain uncertain. Cash, once king, faces an uncertain future. Physical currency offers security during bank closures or cyber attacks. Imagine ATMs running dry and credit card transactions failing. Cash could mean survival in such scenarios. But holding cash has risks. Inflation erodes purchasing power. Global conflict can devalue cash. Storing cash securely is challenging. Home safes can be vulnerable. Safety deposit boxes may be inaccessible. Digital finance offers convenience but has risks. Online banking and mobile payments are vulnerable to cyber attacks and outages. The world stands at a precipice, teetering on the edge of a geopolitical and economic abyss. The decisions made in these critical times by leaders and individuals alike will shape the course of history for generations to come. Will we succumb to the sirens of conflict, plunging the world into chaos and ushering in a new dark age of financial ruin? Or will we find a way to navigate these treacherous waters, forging a more just, equitable, and sustainable global order? The financial fallout of a global conflict, while daunting to contemplate, is not a foregone conclusion. By understanding the risks, by learning from the mistakes of the past, and by taking proactive steps to prepare for a range of potential outcomes, we can mitigate the worst consequences and emerge from these challenging times stronger and more resilient. Diversification, safe haven assets, and a healthy dose of skepticism towards traditional financial institutions are all essential components of a sound financial strategy in an uncertain world. But perhaps the most important asset we possess is our collective wisdom, our ability to learn from history, to adapt to changing circumstances, and to build a better future for ourselves and generations to come. The future of money, like the future of our planet, hangs in the balance. The choices we make today will determine whether we leave a legacy of prosperity or poverty, of peace or perpetual conflict. The time for complacency is over. The time for action is now.